All right, and welcome to week 2 of ARM 54, Principles and Practices. So tonight we will be covering chapters 2 and 3 regarding risk management standards and frameworks, was chapter 2, and then chapter 3 will be on hazard risk. So with that, let's start going right to it. So chapter 2, it's a fairly short chapter, it's fairly straightforward. We have 4 objectives as part of this chapter. And first one, describe the general characteristics and elements of risk management standards and frameworks. And then the next 2 are really explaining the 2 main frameworks that are out there. So explain how an organization can apply ISO 31000 to enhance its performance. And then the next one, explain how an organization can apply the COSO Enterprise Risk Management Framework to enhance its performance. And then lastly, explain how insurers and banks apply Solvency II and Basel regulatory standards. And we'll go through some tips to help memorize some of those things as well. So the first objective, and let's go and hit that one. So risk management standard frameworks, what are they and how are they used? So a standard basically is a means of determining what something should be. And so the best way to think about standards is, you have the metric system or the English system, and and so if you think about how a bolt, 9mm bolt, that they're all made the same way, so they have the same measurements, and so there's been basically an international standard when it comes to that. Same thing when we think of what a foot is 12 inches, and how there's a standard of how we would make tape measures, things like that. So that's where the international standards come from. And then when it comes to operations, we've seen more international standards come into play. Same thing, whether it be ANSI, American National Standards Institute might create those. And then within manufacturing, you also have standards that are created. So really what we're talking about when we talk about standards applies to rules, principles, or measures established by an authority. And so in most countries, there's a standards institute, and in most countries in British, it's the British Standards Institute. In the United States, it's American National Standards Institute, or ANSI. In most cases, standards are voluntary for organizations to adopt, but in many ways, they do establish a standard of care. So National Fire Protection, NFPA, has many standards when it comes to fire protection, and they're voluntary in some cases. But then what also happens with these standards is that a regulatory body, such as OSHA, could actually incorporate by reference a standard, and then it does become a mandatory. Or if there's cases or cases or decisions that are made, you could create a standard of care that way of what the expectations are. In some countries, for ISO standards, they have adopted ISO standards. I believe Singapore has adopted the ISO standards as part of their systems for risk management, and the expectation that all organizations will implement the ISO 31000 risk management standard. So when we talk about risk management standard particularly, we're talking about a document published by a recognized authority that includes principles, criteria, and best practices for risk management. Again, this is the Institute's definition of that. For the most part, the 2 standards we're going to be talking about, they're the most recognized, are ISO 31000 and the COSO framework. And so we'll be taking a deeper dive into those. But there are standards as well for the banking industry and the insurance industry, more specifically, to help address systemic risk in many cases. So within the textbook, they do provide, this little quick sheet or figure that kind of does a quick reference guide of what the standard is and describes it and the basic components of it. My recommendation, as it's been with any type of figure, is this is something that you'll want to really kind of memorize or understand because it really outlines the key elements of each one of these standards in place. So with an ISO, again, we'll take a deeper dive here. The 3 major parts: principles, framework, process. And then there's a little more detail that's in each one of those. And then within the COSO, it talks about encourages organizations to select and refine an adaptive risk management strategy that applies across the organizational functions, levels, and departments. And then they talk about 5 core components. And again, we'll go through each one of these in details explained in the book. And they mentioned the other, BS 31100, which actually ISO 31000 was based, and the FIRMA, Federation of European Risk Management Associations, and then the Red Book. For the most part, I wouldn't expect any questions on those. You're really going to get them on the first 2. And part of the reason on that is having 11 chapters, so there's only so many questions they're going to be able to ask and really what's pertinent. So regardless of which standard you use, if you were to take a closer look at each one of these, is they all share these common characteristics. So one, they're all based on an enterprise approach, right? That you're going to take a holistic view of risk. They also focus on value creation, and the idea that what risk management, what we should be doing is creating value by actually implementing these type of programs. Or you can either, value creation or, sustaining the value, right? Or protecting value is another way to look at that. Other element, integration of ERM with existing processes. The key component there is when we talk about integrating enterprise risk management, you don't want to create new processes, but we really should be integrating with existing and trying to leverage what's already there. There's emphasis on cultural factors. Again, that every country and organization does things differently, and there's different cultural factors that do that. Stress the importance of defining a risk appetite. And what that means is, what's kind of like your risk appetite, risk tolerance, the importance of understanding what you're willing to put at risk. How much uncertainty are you willing to take on when it comes to that? Risk documentation, when assessing risk, that when you're going to go out and actually do a risk assessment, that you have a document process, so you have some way of referencing that, and it's not just a gut feeling on how you're making decisions. The importance of risk communication throughout the organization. Again, that goes to the idea of monitoring and communicating, reporting up, whether it be to the board or even middle management about the risks that are going on. So that way it becomes very transparent in those discussions. And finally, requiring monitoring. That's an ongoing process. The other thing the textbook talks about is as a way to kind of determine how well you're performing is using the RIMS risk maturity model as one example. And so as you implement your program, the idea is, well, how do you know you're doing good? And so RIMS is put together, kind of a self-assessment model, and the 7 attributes that it has to looking at that model is, using an ERM-based approach. I mean, that holistic, you have processes and management, and their risk appetite management, root cause discipline, that you're always looking for root causes. How do you uncover risks? And there's performance management and business resiliency and sustainability. So the idea of does your program help address these various issues? Does it have some means to show how in your maturity that you, for example, are you good at uncovering risk? And each one of these, you can actually have a score of that you're in the beginning process, or you're actually, it's a very robust process. You have documentation and you have systems in place to continue that type of aspect of your program. I'm not going to go into too much detail other than that on the maturity model, but that's something that RIMS has certainly put together, and it's been a way to, again, kind of monitor how your program is performing. All right, so let's dive right into the actual standards. So one of the items is to explain how can, basically 31,000, can apply to your organization and enhance its performance. And so the main components of the 31,000 is the 3 elements: principles, framework, process. And within that process is, a sub kind of element of the risk management process is conducting risk assessments, treating the risk, and the risk monitoring and review. So when we talk about principles, the original, and I'll go back since I was on the ISO 31,000 technical advisory group, the original principle was about 11. It was reduced down to 8 principles. And on the figure that I'll show, they don't show the figure in the textbook, but I think the figure that I'll show you is actually from the standard, will help you understand where these things are coming from. But the idea is that your program should be based on these 8 principles as you design it. And 31,000 was intended to be flexible. I did get a question after the class on the last session of which model should they be using, and how should, which one's the best, or which one that should they spend more time learning. And there's different uses for the different standards. So 31,000 is intended to be fairly broad, and so it can apply to any organization, and it can be customized to any organization. So it's built upon the idea of that it can be flexible, which is important for most organizations like that. COSO was originally designed for the financial industry. And so you see a lot more financial institutions and insurers adopt the COSO framework because of that focus on controls. And actually COSO was part of the controllers group or auditors group. And so you have a lot more adoption by those more that are financially aligned or more aligned in the auditing role. Whereas I think ISO is intended to be much broader, to be adopted by any new organization that may not have more of that financial viewpoint. So what are the 8 principles? Well, and how do they work? Well, the one thing it's highlighted in there, it says, the last sentence, that the strategy, how to create and protect an organization's value. And I'll go to the next slide so you can kind of see what this means. So at the center of the ISO principles is value creation and protection. That one of the core concepts of what we should be doing in risk management is creating value or protecting the value. And another way to think about protecting the assets. And so that could be through insurance. That can be through reputational risk. We create and protect our value. It can be through financial type of instruments. All those things really center around value creation and protection. And if you go around the circle, so all these things are a focus on that. And it's talked about, having principles that the program should be integrated, structural and comprehensive, customized, inclusive, dynamic, based on the best available information. You have to take into account human and cultural factors, and also continual improvement. So if we go back to each one of those, there's actually a better, longer description about what each one of these is. So integrating with all an organization's activities, or risk management should integrate, that's what you want to do. The adoption of a structured and comprehensive approach should be customized based upon the organization's objectives, should be inclusive of the perspectives of all stakeholders. Again, thinking of that, how an HR manager might think of things different from an operations manager or someone on the floor. All those type of perspectives should be taken into account in the program. Ability to dynamically react to changes in internal and external context. So dynamically react, and when we talk about internal and internal would be those things happening within the company, whereas external context would be political, demographic, some type of other changes that are going outside or can be a competitor. So those type of contexts and ability to dynamically react, to move quickly on those things, to create and protect value. Should be based on accurate, comprehensive information sources, mindful of human and cultural factors. Part of that is the understanding that in certain countries, there is no word for risk or a definition of risk. And so that's the idea of how do people react to understanding uncertainty and risk management in general. And finally, the ability to continuously improve. So those are the principles. From a test standpoint, you usually, I would say the main thing is, one of the main principles is create and protect an organization's value. And then you can, anything in a list, you always want to try to have an idea of memorize what that will be. But if you look at, ISO 31000 and what the principles are and how they can be customized or how they're stated in the textbook, they really do align. I mean, they make sense. They should have a customized program, integrated, all those type of things. So even if you didn't memorize all these particular, these 8 principles, I think in a general sense, you'll have a good idea. And I would probably focus on the figure to help you memorize some of the principles behind ISO 31000. The next element within the standard is the framework. So we talk, you have principles and then you have a framework. And so in this, for 31000, Risk management framework is a foundation for applying the risk management process throughout the organization. So just like you would build a house, you're going to have a framework that you're going to operate within. And that framework can be adapted to an organization's specific operations and objectives. So you can have a framework for your finance team of how they're going to operate, and then maybe your operations has a little bit different framework, but they're all going to center around those principles. And so how you develop that framework, you need to begin with an evaluation of your risk context, both internal and external. And they talk about establishing a risk policy. And part of that risk policy is to really define your risk appetite and tolerance, and that's where that comes into play. The other element is appropriate resources should be available for designing and implementing that framework. So again, a figure, is I think the best way to remember how this operates. And so one of the key elements that you see in the center is leadership and commitment. The idea being that you need the leadership to support risk management and the commitment to provide the resources needed to be able to do that. And if we actually start on the kind of the circle in this continuous loop, it doesn't look like arrows, but they are, going in a circle, it's kind of that plan, do, check, act cycle. If you want to look at it that way, the Deming cycle. Yeah, first you're going to design your program, and that's going to be based upon internal, external context. You're going to implement it, evaluate how the implementation went, look for how you can improve it, and then you're also going to integrate that into the entire process. So the integration is that key that goes with this. And then the last component of 31,000 is process. So within the risk management process, you want to establish scope and context. You're going to assess risk, which means identify, analyze, and evaluate. You're going to treat the risk, and then you're going to be able to monitor the risk. And again, you'll see a figure to help you out here as well. The process can be customized or applied to different risks and functions in the organization. And then part of this is risk criteria should be established as part of the internal context, external context, excuse me. And when we talk about risk criteria, what we're really talking about, it's the information used as a basis for measuring the significance of a risk, right? So if you think about from a risk standpoint or criteria of when you might sell stock, for example, or when you might buy stock, there's some criteria that you're going to be using of some different elements that are going on. And it might just not be the share price. It could be some other elements that's going on in the industry that might be some criteria. And so it's kind of like a threshold value. At what point do you, for workers' comp claims or injuries, you look at your injury frequency rate, that as long as it's within this kind of window, that you're fine, but as soon as it crosses this threshold, that's when you're going to take some action as part of that. So that's what we're talking about, and that helps with assessing the risk as well. So this is the figure specific to process. And what you're going to see at the top there is, scope, context, and criteria. Is you have to identify the scope of your program or that specific risk you're looking to evaluate, the context of it, and establishing that risk criteria. Once we've done that, you have that risk assessment process. You identify, analyze, and evaluate. So within risk assessment, there's those three processes. And then once you identify, you've done your risk assessment, now hopefully you've identified ways and you've evaluated ways to treat that risk, and you're going to pick one or many ways to mitigate that risk through risk treatment. What you're seeing also on there, and you kind of see the arrows going around, that this is an iterative process, that this is, you just don't do risk assessment and you're done. Things change, scope and context criteria may change. At the bottom, you see recording and reporting, that you're continually going to be using that risk assessment, recording that information, and reporting it out to the various stakeholders that might be part of it. On the right-hand side, you also have monitoring and review. On the left-hand side, communication and consultation. So within the middle, you're doing this risk assessment, but you're always checking with stakeholders. You have that recording and reporting mechanism, which may go to the board, that communication and monitoring. So all these things, there's a lot going on when we talk about process. And this figure is meant to identify of what that risk management process does look like. Sometimes people talk about the core risk management process, which in many cases they consider that to be the risk assessment, because most of the work that goes on is really assessing your risk. And to identify all the risks and analyze them and evaluate them, that's where the nuts and bolts typically occurs. And there's actually another standard, which is called risk assessment techniques and tools, which is ISO 31010, which identifies there's over 100 different risk assessment tools that you can use depending on the type of risk you're intending to evaluate. All right, so let's go a little bit more deeper into risk assessment. So when we talk about risk assessment, we're talking about what includes identification. So development of a comprehensive risks that impact objectives, both positive and negative. Sometimes people might call this like a risk registry, but the idea is you want to identify every type of risk that actually has an impact on your objectives. Not just a risk to the organization in general, but I think, where enterprise risk management and the standard comes into play is it's really, the whole thing is about objectives and how you, again, value creation, things like that. When you think about it, when we identified risks in the past under the traditional approach, it really only looked at hazard risk. And when we do this whole list of risks, we should be evaluating operational, financial, reputational, all those type of risks that have an impact on the objectives as well. The goal of identification, identify as many risks as possible. And so that's really a brainstorming technique. And so even brainstorming is considered a risk assessment technique. SWOT, a SWOT analysis, Delphi, all those things you might hear later are really part of that. The next step is analysis, right? That analysis can be quantitative, qualitative, or it can be a combination. And many times it is a combination. And when we do that analysis, it should include determining the level of risk and the potential effects on the organization, both tangible and intangible, right? That there might be, when we talk about tangible risks, a loss of product, those type of things, but the intangible is reputation, so that's where that comes from. Then finally, evaluation. We're going to apply selected risk criteria to determine impact and allow decisions regarding risk treatment. So that analysis gives us the numbers, what the potential impact can be. The evaluation is looking now, comparing that to what our criteria is. What are we comfortable with, right? Because you can make a decision and say, we're going to accept a certain amount of risk, or we'll have that residual risk, and we're willing to accept that risk because our risk appetite is large in that certain area. But again, the last part, evaluation, apply selected risk criteria to determine impact and allow decisions regarding the risk treatment. So then we get to risk treatment. So risk treatment is the ongoing process of deciding on an option for modifying risk, either selecting a new risk treatment and then repeating the assessment. So as we talked about, this is an iterative process. When we see this kind of circle, that we're continually going to be assessing risk. It's not a one-time and done process. Some of the ways that we can treat a risk that discusses is that we can avoid the risk. We can retain risk, right? That we're accepting it. Transfer, all or part of it. When we talk about transfer, we're going to buy insurance in some cases. In some ways, you can't transfer risk. Again, when we're talking about insurable type risk, or we do a combination of these things. When we, in a treatment, can eliminate the sources of risk, right? In some ways that can call that avoidance as well. We can alter the likelihood, which is frequency, or changing consequences of events from risk, which is severity. And the example I usually give when we talk about how treatments can have an impact, and when we talk about severity, is again, sprinklers in a building doesn't prevent a fire, but it can obviously prevent a fire from spreading, which addresses the severity. Now that's an example again on the from a hazard risk standpoint or insurable risk. But if you think about financial risk and others, there are ways that we can impact the likelihood of certain events occurring, kidnap and ransom, things like that, through training, where we operate, ability, if we have issues with human capital that we're not getting the right talent, or it's the cost of living is high. Working for a public agency, there are some universities as well as cities that actually provide a subsidy for their workers to be able to live in the community, and or they provide housing, things like that. So that's what we talk about mitigating and retreating risk. There's other ways of not just looking at hazard risk. And finally, when we talk about risk treatment, we should include some performance metrics and accountability to ensure that we're meeting our expectations of what that risk would be, or meeting the criteria, so that we can, if it's not working as intended, then we need to change. Lastly, or part of it, risk monitoring and review. So when we talk about that, includes monitoring and reviewing both internal and external changes and how these changes might affect risks and their treatments. So the monitoring, again, the political environment, the demographics, the countries in which we operate, that could be part of that, changes in laws. Monitoring should also include recording the assessments and reporting them internally and externally, and also determining the frequency, distribution, and method of reporting. In some things, it may be a yearly report. In others, it should be a monthly, or it could be weekly, again, depending on the type of risk that we're monitoring. It's going to be different for each one of those. And so that's where 31,000 is quite flexible, is you can have implement for the entire organization, but then within the organization, you can have specific requirements of how you're going to use the standard, more specifically for operations or your financial operations or other parts of your company or organization. COSO. So what is COSO? COSO stands for the Committee on Sponsoring Organizations of the Tradeway Commission. And it's been around, early 90s. I think it originally was when they came out with the original COSO framework, or the COSO cube way back then. And now this is an updated ERM framework, which they call COSO ERM. And the name of the actual standard, Integrating with Strategy and Performance. Again, I mentioned before, primarily was used in the financial sector, with its main audience being auditors and controllers. But it's not only to respond, but to proactively plan and take advantage of emerging risks. So one of the selling points, if you want to call it, the COSO framework from a financial standpoint for those organizations, is really kind of looking ahead and really trying to identify it with a focus on emerging risks, and having different layers of the organization be able to focus on those. One of the main goals is to move from silos to integrated ERM approach at all levels and functions. And again, I would say that's also the goal of 31,000, is to try to move things from a siloed approach to how do you integrate the operations and information that's flowing, because it does impact the entire organization. The idea that management boards and employees should consider risk when selecting business strategy. And that strategy should be able to adapt to conditions as they change, and will also align with the organization's mission, vision, and values. Again, you might be seeing the same thing when we talk about ISO, but this is specific to the COSO. Organizations must continually assess strategy, determine strengths and weaknesses as new and changing risks emerge. And ERM can be used more than manage risk, but maintain a competitive advantage. So these are the selling points of the COSO, and so these are the main things that you want to look at when, again, from taking this test on that. And I put a note when they talk about strategy and performance as kind of in the name of this, right? If you can think about them, I know down below is you can substitute for objectives in ISO 31000 model. These are very similar, where both of these organizations landed, and it talks about decision making and objectives. So all these things really align, but you do want to identify how ISO and COSO are a little bit different and how they can be applied in there. One of the main things that the textbook, the objectives, it says is, again, how an organization can apply the framework to improve its performance. So these are the specific areas you want to look at. So the 5 components that it can be leveraged is governance and culture, strategy and objective setting, performance, review and revision, information, communication, reporting. So typically, again, anytime there's a list, specifically in here, and there's like the 5 components, you can expect a question on that to say, what are the 5 components of the COSO framework? Or which all these are components of the COSO framework, except, or something like that. The other key element on there is in the paragraph above, it's about all organizational functions, levels, and departments. So the idea is that no matter where you are in the organization, you should always be looking at the 5 components of governance and culture, strategy, performance, review and revision, and information. And the note in there is the first three of the five components are integral to an organization's achievements of enhancing value, right? So the top three: governance and culture, strategy, objective setting, and performance. Those are the key three. Again, from a question standpoint, those are the things that you're most likely to see on exam. And then in there, they don't go into great detail about these, but the five components are actually supported by 20 principles. You know, why one organization may choose the COSO framework, or the ISO over one or the other, is simplicity. One of the things I think the COSO framework has had challenges in the past is it was fairly complex. It wasn't, used to be 126 pages. I'm not sure how many pages it is now. They did shorten it, but it was always a more complex standard to try to implement for many organizations. So deeper dive. So governance and culture, what are we talking about? So governance can refer to a board of directors, partners in a venture, or owner of a small business. So when they talk about governance, a lot of times we think of board of directors, but it can be, again, just the owner when we talk about that. Culture defines, and this, they describe here, encourages desired behavior, promotes awareness of the expected and tolerable levels of risk. And again, when it's fully embraced by all employees, helps the organization achieve its objectives. So the focus is, how do you get that governance and culture in the organization? What's a large corporate culture or a small mom and pop store? You know, the idea is, how can you apply that COSO elements to it? We talk about strategy and objective setting. What they're looking at is defining an organization's risk appetite. You know, is it risk averse or risk taking? And so whatever that strategy is should be aligned, or you know, where that risk appetite is, really should be aligned with the strategy. Example I give is, you know, of Google with lots of resources has larger risk appetite for financial risk, but not reputational risk. So if you think about, you know, Google, I think, well, my first year there bought about 55 companies the first year. Well, that's a company a week. So they had a risk appetite. They were very, risk taking, willing to, and because they had the financial means to do so, they can take more risk to do that. But one of the things that Google is very focused on is their reputation, especially as it comes to privacy and those type of things. So where the risk appetite might be large for financial aspect of mergers and acquisitions, when it comes to things that can harm their reputation, they're much more, they have a much smaller risk appetite on those type of things. And so defining that strategy or objectives, identifying where that risk appetite is really important for an organization. Next bullet, determining risk appetite and strategy are dynamic decisions that are considered together, right? The idea of your strategy and where you're willing to go, do things, how willing you are to expand quickly can certainly be part of that too. And the selected strategies realized through business objectives using measurable performance targets. This is nothing new from a strategy standpoint. Everything should be metrics driven or data driven. And you need to have, you know, how do you know you're doing good? And what's the end result of achieving your strategy should be part of that. And again, that's where that risk appetite comes into play. Performance are the practices that allow an organization to continually identify, assess and respond to risk on an ongoing basis. And then it's also the principle that supports this component in role decision making. So the idea of how do we identify and prioritize a risk, assess their severity, and then implement the responses. So again, these are the words that are used within the standard. And in many ways, you might be seeing, this sounds pretty similar to ISO. They are, both of them are fairly close, but they use really different, you know, just different wording and how they decide to get there. We really focus on the five main elements of the COSO is probably more likely the question you're likely to see on the exam. Going to the lesser known standards, Solvency II and Basel II and III. These are regulatory standards adopted by the European government. Solvency II regulatory standards for insurers in Europe and the European Union. And the basic requirements is that it requires insurers to have an effective risk management system, that they have to conduct its own risk and solvency assessment. Think of that as the too big to fail assessment. This is, again, but on the insurer side. They have to have effective internal control systems and audit and actuarial function. And that insurers can demonstrate strong risk management standards and may be able to reduce by doing that, they can actually reduce their capital requirements. And we talk about capital requirements, that's how much capital they need to maintain to pay claims, how much they have to have on hand. The idea is if they have major losses as an insurer for the wildfires or those type of things, they have the capital to be able to pay for those claims. Basel II, and then it talks about Basel III, is a new regulatory standard for global banking industry. It establishes risk management principles that are designed to address systemic risk. So essentially, this is their version of Dodd-Frank, or the too big to fail aspect, is that they have some principles designed to really prevent a huge bank failure. The way I remember which one of these addresses which, think of Basel as bank, so B. And so the other one, solvency, is really dealing with the insurance market. But if you remember B, or Basel, or B is for banking, that makes it a little bit easier to remember which one is addressing which aspect of it. There's usually a question that talks about which one deals with insurers, or which international standard deals with this area. And that's why I try to make it easier for you to remember, because you'll probably remember COSO and ISO, but these two other standards are ones that are lesser known and you may not know as well. I'm misspelling on that slide. Financial institution application of Basel II regulatory standards. So these are the processes that should be followed, that Basel regulatory standards require. So they need to identify the risks, measure exposures to those risks where possible, ensure an effective capital planning, monitoring programs in place, monitor risk exposures and corresponding capital needs for an ongoing basis, and then taking steps to control and mitigate risk exposures, reporting to senior management board of an institution's risk exposure and capital. Typically, you're not going to see a question that goes in that much detail on Basel, because for the most part, it's going to be more focused on the U.S. and what's expected there. But there are additional principles on 2.16 that you can look at as part of that. The main thing is understanding which standard is for which. Basel for banking, B for banking, and solvency is for insurers. All right, so that is chapter 2. Let's go to chapter 3, hazard risk. So for the most part, for those that have been that work in the insurance environment or safety, hazard risk, this is probably the bread and butter. This is probably one of the more straightforward chapters we're probably going to see. When we get to chapter 4, we'll be talking more about operational risk and financial risk and strategic risk in a little more detail. But for hazard risk, they only have 3 objectives here. When they redid this chapter, they've actually they have consolidated this quite a bit. There used to be a lot more objectives, but I think they tried to simplify this aspect of it. So first, one of the objectives, describe hazard risk and its treatment. Right, what does that mean? Then be able to describe the asset exposed to loss, cause of loss, and financial consequences of loss for the following categories of exposure. So we'll talk a little bit more detail about property exposures, liability, personal, and net income. So as we do that, you have to be able to describe the asset exposed to loss, cause of loss, and financial consequences for property coverage. Again, and the next one, the assets exposed for each on the liability, and as well as personnel and income. And then finally, the last portion is be able to summarize the loss exposures addressed by each of the various commercial insurance policies. And there's actually a table I think makes it a little bit easier to be able to follow that. All right, so what's the nature of hazard risk? And again, we've talked about this in chapter 1. For the most part, hazard risk is considered an insurable risk. It's a pure risk, right? And a traditional focus of risk management professionals, and it's still important. That's why we still talk about this, even though we talk about all this operational risk and non-insurable in the next chapter. So it's important to understand the nature of hazard risk. So using the definition of risk, or of hazard risk as well, type of risk that provides potential for only a negative outcome, typically includes the following hazard risks. So, and we'll talk more in detail about these: fire and other property damage, windstorm, other natural perils, hurricanes, that can be a fall into that, theft and other crime, personal injury, business interruption, disease and disability, which really deals with work-related injuries and illnesses, and liability claims. There's three main categories when we talk about hazard risk. There's personnel risk, which is the uncertainty of loss of key employees, death, or workplace injuries. You have property risk, uncertainty related to loss of wealth due to damage, destruction of property. And lastly, liability risk. And so when we talk about liability, uncertainty due to bodily harm or injury, death, or harm to others. So when we talk, think about trip and falls, that would be a liability risk. Auto accidents can be part of that. In many ways, these things all tie together. You can have an exposure that addresses all these type of main categories of risk. When we look at measuring and managing risk, so for those that have been in the industry, typically we always talk about frequency and severity, right? The frequency of a loss is, the number of losses you may have, and the severity is really the size of loss, right? How big of a loss? How much is the work comp claim? How big was, the injury, the auto accident, those type of things. And then the other aspects is, how can techniques that we can use to manage hazard risk. And this list is a little bit longer when we talk about avoidance or void risk or we can retain it. These are specific to hazard risk. So we can avoid a certain type of hazard risk, which means eliminates the possibility of loss. Separation, which is dispersing activity over several locations. If you think about that, if we have a manufacturing plant, we don't maybe want them in the same state. We want to separate those activities. Or if we have a fire, that's part of separation. Even we can have them on the same property, but they're separate so that we can, if one building goes down or piece of equipment, we have that. Duplication is the same idea as you're going to have reliance on backups, again, in case that one part does go down. Diversification. This might be from a profit standpoint. You see a lot more companies that are diversified. And if you think of diversification, just like if you're buying stocks and for your retirement, they always talk about diversification, right? You don't want all of one stock. You want to separate that just in case, one stock doesn't perform as well, you might be able to make it up on another. The other techniques, prevention, which is the focus on reducing frequency of a loss, and then reduction, which is reduces the severity of losses. And the most common techniques are prevention and reduction. So when we think about, because most people can't avoid a risk, they're still going to if they want to stay in business, they got to do the work. Separation, duplication, that's more of a technique that's just standard if you're from a property standpoint or buildings and assets. But really, prevention and reduction is the main focus when we talk about which techniques are used the most as it applies to hazard risk. What's the role of insurance in all this? So talked about before, and really insurance doesn't prevent the hazard from occurring. It just replaces the financial aspect of it. So that in technical or the textbook terms, it's a technique that transfers the potential financial consequences of a certain specified loss exposure from the insured to the insurer. So that's the book definition, right? It's buying insurance. You're taking that financial consequences that we talked about, and it's from the insured. They're the ones that hoped that it wasn't going to happen, and to the insurer, and it's just a transfer of dollars. It's typically used for low frequency, high severity events. So really, when we talk about low frequency, high severity, or this is when it should be used, I should say. Most companies they buy insurance for everything, but it's really for catastrophic claims. So if you think about those claims that don't happen that often, but when it happens, it's bad. Hurricanes, floods, wildfires, earthquakes. So earthquakes, that catastrophic coverage is really where you want to use it for. When you already know the frequency of events and you pretty much know the dollar cost almost every year, that's when you want to retain it, because you should be able to handle that. It's when you have those rare events, that's really where insurance has the biggest impact. Typically used for events that have more uncertainty and or activities that cannot be avoided, right? Again, hurricanes, earthquakes, more uncertainty. Or again, things that you just, workers' comp, you got to have it. But you do roofing, it's a higher risk, you just got to do it. And it's also the most common method of risk transfer. So That's really the role of insurance. Again, high frequency, low severity events should be retained. Part of the reason why is because they're more predictable. So some of the basic terminology that's already in the textbook on page 3.6. And this is something you should know what the, because they'll have questions on the textbook about some of these, what's a peril? Typically, I think it's one of the perils. It's the cause of a loss. What's how do you differentiate that between an exposure, things like that. So you want to have an understanding of these various of the terminology within the insurance industry. So I'm not going to go over each one of those that you can have on there, but you definitely want to understand, wrongful act, legal liability, and things like that. So other aspects about the role of insurance. Insurance limitations to risk transfer, right? So within, when we talk about transferring risk, many policies, it's first dollar coverage, meaning you have a loss and they pay the whole thing. Mainly under workman's comp, you see that. But if you think about, let's apply this to your own life, deductibles or self-insured retentions, is that you may have $1,000 deductible on your homeowner's policy, meaning that you eat that first part, or on your car insurance, a $250 or $500 or $1,000 deductible. What that does when we talk about, let's say window claim, well, you really want to pay for those on your own. They don't, they're low cost, don't happen that often. And when you do that, if the higher deductible that you have, actually the lower your premium should be, because the idea is that you're going to take on more of those low frequency or low severity type of risks, and you're only picking up for those higher things. So even as a driver, personal insurance, when you look at this, you also want to retain as much risk as you can, or you feel comfortable with based upon the assets that you have. Sometimes, again, limitations that you may not, from an insurance standpoint, and we talk about the limitations, is you might either have high deductibles, you could have policy limits may not provide enough coverage for large loss events. So meaning that, say you have an auto accident, it was a major accident, the 1530 coverage, that might be minimum most states, meaning $15,000 for individual, $30,000 for the entire claim. If that's only coverage you have, that means once that coverage is exhausted, now anything above that would you'd have to pick up individually. And so, quick lesson on auto insurance coverage: the more assets you have, you own a home, those type of things, actually the higher policy limits you want to have on your auto coverage, because if you did have a major accident and you're making good money, they can go after your assets after that policy limit is done. So, if you want to do a 250 to 500, then you have umbrella coverage. That's why people do that, is because if they did have a major accident, then they could lose their home if someone decided to go sue them for that if they didn't have enough insurance. There might be policy exclusions for certain exposures. So in California, for example, most policies do not cover earthquake. You have to buy an additional policy for that specific. May not provide, insurance may only provide 20 to 30% of operational risk losses. And so, again, the idea being, from a hazard risk, when you think about the operations of an organization, whether it be public sector or private industry, insurance really only covers 20 to 30% of the operational risk losses, again, from a hazard standpoint. There's so many other things that may not cover, or there might be exclusions for. And typically you can buy insurance for anything, and really the issue is cost of the coverage. So when you think about insurance, yeah, you can buy it, but it's also taking resources away, the productive resources, to make a profit the more insurance you buy. So that's where that optimization comes in that we talked about last week. So again, some examples: homeowners insurance excludes flood and earthquake. A lot of coverages exclude, cyber risk. And there's new insurance coverages. There's always some new insurance coverage that can be out there. And again, it's how much you're willing to pay for those. So a little deeper dive: loss exposure. So as we talk about hazard risk, and we think of exposures and risks and all that. So within the textbook definition, a loss exposure is any condition or situation that presents a possibility of loss, whether or not actual loss occurs. So again, we might, by having employees, we now have an exposure for a workers' comp loss. By having vehicles, we now have an exposure for auto. Depending on the type of operations, or if we have employees, we have an exposure for employee theft. Now, whether the loss occurs or not, we still have that exposure, and there are certain coverages. Many times we can buy insurance for that, but there's also a lot of risk management or control techniques or controls we can put in place to treat those exposures as well. So every loss exposure will have three elements, right? So you can have an asset exposed to loss, the cause of loss, again, talked earlier, which is also called a peril. So there's always a question about peril, and the financial consequence of that loss. So let's go kind of take our workers' comp example, or personnel, right? Asset exposed to loss. Well, employees are assets. They're exposed to a loss by getting injured, sick, those type of things. We have a cause of loss. They could get, actual injury, again, sickness, those type of things. And then if they have to have a medical procedure, things like that, there's the financial consequence of that loss. So that's why it meets all those three elements. Again, a vehicle, it's an asset, it can get damaged. Get in a car accident, that, there's the peril. And then the financial consequences are fixing the vehicle, right? And as well as the employees there, then you also have that asset as well. So that's the way you want to think about the three elements. There will be a question, I guarantee you, on the three elements of a loss exposure. And all these are elements of a loss exposure except for, and you'll probably have some question like that on the exam. So when we talk about asset exposed to loss, a little deeper dive, anything of value to an individual or organization that's exposed to a loss. So that can be property, so building, cars, equipment, investments. If you think about your stock, there's investment, things like that, or buildings can be, again, that's kind of the first part though. Money that is owed in cash, intangible assets, patents, copyrights, trademarks, and as well as human resources or human capital, people. All those are assets that are exposed to a loss. Money that is owed in cash. So if you think about your accounts receivable, so if you had everything on a computer of who owed you money, and you had a major fire and that all burned up, and now you don't know who owes you money, and you have no way of collecting or those type of things, that's why that would be an asset exposed to losses. Those account receivables are an important asset, the billing and having those records, as well as cash that may have burned up. That would be important too. Cause of loss. So examples include, in this case, fire, windstorm, theft, employee injury, hacking. That can be a cause of loss, or a peril. Then there's hazards or conditions that increase the frequency or severity of a loss, right? So we know that, for an auto accident, there's an exposure, right? We can get an auto accident, there's hazards, but then hazards could be talking on the phone. What are some of the different, the driving in snow could be an additional hazard that increases that exposure to loss, right? So all the, driving in fog, all those things are now considered hazards. And so where people get confused and sometimes on the exam is really having an understanding of a cause of loss. There's an exposure, and then there's hazards, and then there's the cause of loss specifically are perils. So you just want to make sure you fully understand and really read the question on the exam of what they're really asking for in there. And then we also have different hazard classifications. And this is actually, they don't have in this textbook, but I still include it in there. Moral hazard, morale hazard, physical hazard, and legal hazard. Probably not going to be on the exam, so I'm not going to go in detail, but the idea of a moral hazard is the idea that when you rent a vehicle, do you drive it the same way as your personal vehicle? Because it's not yours, or you bought the insurance, those type of things. It's how people use or operate things that may not be their own, and so that's where that comes into play. Well, actually, here's more of the definition. So moral hazard, condition that increases the likelihood that a person will intentionally cause or exaggerate a loss. Again, that's, so intentionally cause or exaggerate, my back or those type of things. And again, it's considered to be a deliberate act. So this would be more of an insurance fraud issue. Morale hazard, condition of careless or indifference. And this is the auto insurance or the rental car example I was just giving you. The physical hazard, tangible characteristic of property, persons, or operations, tends to increase the frequency, severity of loss. Ideas, some of these hazards be slippery floors, chemicals used in the lab, things like that can be part of it. Legal hazard, condition of the legal environment that increases loss frequency, severity. And you think about the legal hazard, that could be the jurisdiction, right? Having a court case in California versus Texas, or San Francisco versus Orange County, in California. So those are the types of things we talk about a legal hazard. It's the environment where a court case or things might happen, right? Or some areas, are more litigious. So in California, we see a lot more people suing each other, where we might not see that in other states. And the other element that we talk about is the financial consequences of loss. It really depends on the type of loss exposure, the cause of loss, and loss frequency and severity. So again, financial consequences when it comes to a vehicle, it's fairly easy to be able to get an idea of the cost of replacing the vehicle. But when it comes to like the personal injury of the person in the vehicle, that can be in the millions of dollars, right? It really depends on the type of exposure, what was the cause, and then how frequently do those occur. I mean, being the owner, you want to look at that, or the risk manager. And then part of the challenges when assessing those, and I'll talk to the next bullet of the loss, can be difficult for certain exposures. So like business interruption or loss of key personnel, right? The reality is the CEO of a company, if they left the company, or they kidnapped and ransomed or injured, or something like that, obviously there's going to be a much more huge impact on that. But then what's the if you have insurance for that person from workers' comp, they're going to pay the claims or whatever, but there's so much larger loss financial aspect of it. Business interruption could be the same type of thing, of depending on when the loss occurs, right? If you had for a grocery store and you had a power outage right during Thanksgiving week, that's a huge financial loss, because it's going to have a greater impact compared to something happening just on a normal non-holiday week. So business interruption, all those things, the financial impact, I try to identify those can be a challenge when you're trying to determine the consequences. So types of loss exposures, right? So we've talked about, again, this is where things kind of get a little funky, because now we're talking about, causes of loss and perils and things like that. But now let's talk about the loss exposure. And there's really 4 types that we're going to talk about. And this goes through the rest of the chapter here. And this is part of this is now really the second bullet. Describe the asset exposed to loss, cause of loss, and financial consequences. So we just really talked about hazard risk and its treatment. We talked about all those type of things of asset exposed, cause, and financial. Now what we need to do is, how do we apply that to property, liability, personal, and net income? And so we're going to go through each one of these a little bit more detail. So the 3 elements of loss apply to each of the 4 types, right? Property, liability, personal, income. Again, we see it: asset, cause of loss, financial consequences. And the types of loss exposures are unique in how assets are exposed to loss. So the first one we're talking about is property loss exposure. So when we talk about property loss exposure, it's a condition that presents a possibility that a person, organization will sustain a loss resulting from damage, including destruction, taking, or loss of use to property in which that person or organization has a financial interest. So again, we think about as our organizations that we work for, our building, the vehicles, all those things, damage to, or completely destruction of, or loss of use, all are considered property loss exposures to that organization. When we talk about property loss exposures, there's tangible versus intangible property. So when we talk about tangible, that's a physical form, right? That's the building. It can be, or paperwork, things that can be part of that. Intangible really has no physical form. That's going to be your patents. It can be data in the cloud. But all those are considered to be, can have a property loss. And then real property, when we talk about, it consists of land and all structures that are permanently attached to land, right? So we can still have property. It could be equipment, right? A boiler, it can be a press or whatever we might have in the organization that we have to use. Could be vehicles, but when we talk about real property, now we're actually talking about the actual land and all structures that are attached to the land. This is something actually from the old textbook that I include because I think it's actually makes it easier to understand. As we go through this, so elements of a property loss exposure, you have an asset exposed to loss. So it could be tangible, real property, personal property, office furniture. You have intangible. Then you have your causes of loss to that. Again, lightning or hail, tornado, high wind, theft, snow, fire, mold, and then the financial consequences. So what with this slide is actually, I think, one of those that makes it easier to understand. And actually, they do have a new slide in here. I think it does address this in the same way, but in a easier form as well. But this is really what you want to be able to focus on, are the different elements of property loss exposure, and how does the three elements fit into that. Then we have liability loss exposure. So a condition or situation that presents the possibility of a claim alleging legal responsibility of a person or business or injury for damage suffered by another party. So trip and falls, right? It also could be an auto claim if someone hits someone else. Those type of things are all, again, that, condition or situation presents a possibility of a claim alleging legal responsibility. Even if claim is defended and does not result in payment, costs are incurred to defend, or could result in a loss to reputation that could result in a financial loss. So the reality is you can be sued for anything. You can have hold harmless agreements. You can have all those things in place, insurance coverage, but that does not prevent you from being sued and having to pay for the claim of that. And as it indicates in here, that even if you win, if it was a high profile, you could still have loss of reputation, which then can obviously impact a financial loss. So here's an example of an element of liability loss exposure. So asset exposed to loss or liability is money. Payments that may be required to include the following: damage to the plaintiff if the claim is not successfully defended, settlement costs, legal fees, court costs. The cause of the liability loss, there's it's more generic, but again, it could be slip and falls, any of those type of things could be the cause. And then the financial consequences is that the financial consequences of the liability loss exposure are limitless. If, depending on the state, there may be requirement or maybe regulations that put caps on limits of liability. But for the most part, when you see people claim or sue for $10 million, that's part of the reason when we talk about being limitless and liabilities, it's an open door, depending on the type of claim that's presented. Personnel loss exposure. So this is more specific to really human capital. So condition that presents possibility of loss caused by a person's death, disability, retirement, or resignation that deprives the organization of the person's special skill, knowledge that the organization cannot readily replace. So you might be surprised to see in the resignation or retirement. Well, the reality is when we talk about loss exposure, personnel loss exposure, we kind of tend to think of workers' comp or an injury. But the reality is that having someone retire that has that institutional knowledge, or they resign or quit, or they move to another company, that, depending on their talents, can also have a potential loss to the organization because of that talent that's going away. So succession planning, having those type of things, is actually a treatment to make sure that we have the right talent when people do end up retiring. How do you prevent people from leaving? That's why many employers, actually most employers, have good benefits plans. If you think about why when you went to work for another organization or when you first got hired, one of the key concerns many people had is what's the benefits are like, right? That's one of the things that helps people keep at an organization. Bonuses, all those type of things are helping keep from preventing of losing key personnel. So for family, personal loss exposure, it's a condition that presents possibility of financial loss to an individual family, such as death, sickness, or injury. or unemployment. And so that personal loss exposure, when you think, I put in there's their insurance for this. Well, that financial, that's life insurance, right? There might be disability insurance. So there are actual things when a person can no longer have income from a family perspective as well. And then going back to this kind of the way these look on here, asset exposed to loss, again, personnel, causes can be death, disability, retirement, voluntary separation, and then the financial consequences really depends, buried on the cause of loss, partial total, if it's temporary disability, key personnel, all those type of things are part of that. And then lastly, the type of losses and type or net income exposure. So what is the net income exposure? A condition that presents the possibility of loss caused by a reduction in net income. Well, the reality is all the three things we talked about above are typically will cause a net income loss because there's going to be some financial aspect associated from a personnel loss or property loss, all those things. So they typically present some type of net income in most cases. So net income is revenue minus expenses and income taxes in a given time period. Don't worry, it's not going to be on the exam. And net income loss is a reduction in revenue, increase in expenses, or a combination of both. That one's probably the one that will be on there, is the idea of understanding that a net income loss is not, it could be, again, a reduction in revenue or an increase in expenses. So even though maybe, you may have had to pay more for equipment or you didn't lose any sales, but if you had an increase in expenses, that can be considered a net income loss. Net income losses are often the result of a property, liability, or personal loss, right? So again, you're usually going to have, if you have one of the other losses, you're almost always going to have a net income loss. But you can also be the result of loss of goodwill, failure to perform, or missed opportunity. And often these are really considered to be indirect losses. We talk about loss of goodwill, that could be the reputational risk, something happening where you may have not had an operational loss, but something happened in the paper. All those things. And again, that's where it's an indirect loss, but it's certainly going to impact your sales. Missed opportunity could be if you're an organization and you didn't get the product out in time, right? That you had a certain, let's say those fidget spinners, right? Were all the craze for a while. And you manufactured those, or you started to, and then you produced all these things and then you weren't able to sell them. That could be a loss because you weren't quick enough to be able to get those to market. Again, the standard format, asset exposed to loss, is a future stream of net income cash flows to the individual or organization. Some of the causes could be property, liability, personnel, and then also losses stemming from business risks, from poor strategic planning. And again, depending on the financial consequences, it really depends. They're really varied on there. So this is the chart that's actually in the book that summarizes all that we just talked about. And I think this is a really good one to probably highlight for the exam, because it does go through all the different types of what's the asset exposed to loss, what's the cause of loss, and then the financial consequences of those losses. And it does that in a pretty concise table. And so if anything, you'll have a question that's going to have something like this and ask, which one of these addresses intangible or would be what from an asset exposed to loss or something like that, or cause. And so it might have some of those different descriptions in there. You got to say and tell whether it's a property, liability, personnel, or net income. All right. So this is the final portion. We're going to talk about commercial insurance policies. And so for our objective on this one is to be able to summarize the loss exposures addressed by each of the various commercial insurance policies. So when we talk about commercial insurance policies, the idea is that there's different coverages for different exposures, right? So you have workers' comp coverage, you've got property coverage, and then you've got general liability, all these things. And then, most of these have developed through regulation, and there's common usage or standardization, and most of them have, standard forms. So no matter what carrier you're with, there's usually going to be some type of standard form that's used by each. To say what's covered or what's not covered for the insurance. And so they're all pretty similar, no matter what insurance carrier you end up going with. So when we talk about, one of those property casualty insurance, really we're looking at, property, liability, and line of business or insurance lines as part of that. This is hard to read, but in your textbook, where this comes from is 3.12. And this is, I think, really a good way to look at all the different types of coverage. So you have the commercial line, and within commercial, it's property, and you have commercial property, and you have business income, and then what's the product that's really being sold for those, and what are the loss exposures addressed, and where is this coverage usually available. And so the coverages that it talks about is, property, liability, motor vehicle or auto. So you have business auto, motor vehicle, marine, aviation, transport, pecuniary, which, more credit policies, and then what they consider occupational injury disease, which is more your workers' compensation on the last one. So we're going to go actually a little deeper dive on really each one of these and what does it mean, what do they cover. So when we talk about property insurance, just by name, insurance that covers commercial buildings and their contents against various types of property losses. When we talk about monoline policy, there's a description in there, but basically monoline policy covers one line of business. But you can also have a package policy that may cover two or more lines of business. Probably not as important, but you just need, one of the things that's included in the textbook. Named peril. So when we talk about that, specific cause of loss listed and described in an insurance policy are used to describe a policy, right? So a named peril could be earthquake coverage, right? Or flood insurance. It's very specific to the peril, right? Which is, a peril, again, is the cause of loss. The physical loss that is a physical, not just financial, results immediately from the occurrence. There's all risk policies, insurance policy that covers any risk of physical loss unless the policy specifically excludes it. And then this is kind of, they put this in there, and a Bailey's customer policy. And you're probably going, what the heck is that? This is coverage damage to customers' goods while in possession of the insured. And the way to think about that is auto shops. They have a garage, I think it's garage liability, not the right term, but anyways, when you take your vehicle in, you leave it overnight, they have a policy if something happens or it gets stolen while it's in their possession, they have coverage for that. If you ever go into a parking garage, you'll see exclusions that says we're not responsible for anything. And sometimes you'll even say that this does not create a Bailey coverage or something like that. They might use that term in some cases, but by basically posting that sign, they're essentially saying, even though your car might be in this parking garage, if anything happens to it, we're not responsible. Whereas, again, a garage or some other places might be responsible for it. Other type of property insurance that goes with this, business income insurance, or business, a lot of times we think of that as business interruption, which covers loss of business income and extra expenses incurred while repairs are made after a covered loss. So if power outages and you lost, or you had a backup or flooding or something like that, there might be some business interruption. Industrial all risk, what they'll call special risk insurance. Customized policies typically for large enterprises. Again, you're not really going to get a question on that, most likely. A builder's all risk insurance. So the idea of builder's risk, you may have heard of that term, is when you have new construction going on, as you go from foundation to framing and all that, the cost of the building or the value of that increases. And so builder's risk is that if something was to happen during construction, a fire, vandalism, something like that, that it would basically cover the building during that time of construction. You also have multiple insured interests, owner, contractor, subs, because if something happens now, how are people going to get paid, those type of things. And increased exposure of loss due to theft, weather, and fire is typically what a builder's risk insurance policy would cover. Equipment breakdown. So insurance, a lot of times it's referred to boiler and machinery insurance. Boilers and pressure vessels, electrical equipment, mechanical equipment. You can also buy insurance essentially for that as well. The reason why we're going through this is that it's important to understand all the different types of what you can purchase. And again, the idea is to be able to summarize the loss exposure addressed and what are some of the policies that might be available. And just understand, as we go through this, you don't have to memorize all these things, but if there's a question to understand what would that coverage be or what would it cover as part of that. Fidelity and crime insurance covers criminal acts committed by persons other than the insured. So some examples that they provide: employee dishonesty. Okay, employee, either alone or with others, takes money or property from a served employer without authorization. It can be computer fraud, extortion, forgery, alteration, theft, and robbery. So fidelity and crime insurance, that would cover all these different types of examples. Surety bonds. So a surety bond essentially is what describes as considered to be a three-party agreement, right? You will most likely have a question on this of the surety bond because of the three elements here. That it includes a principal, the surety, and the obligee. So the principal is the party whose obligation of performance the surety guarantees. So let's say this is usually used in construction, right? So if this is the contractor that's building, who's the obligation of performance, it's going to guarantee. The surety is the party or the insurer that guarantees the obligee, the principal, will fulfill the obligation to perform. So the surety might be the bank or the bondholder, and the obligee is the party who received the surety's guarantee, the principal will perform. So if a contractor, they have to have a bond and the amount of the contract price, right? And so they buy that bond. And so if there were a failure to perform, something happens to where they're not able to fulfill that, then that bond that I have will basically replace the monies as part of that. And again, it's most commonly used for construction projects. Other type of coverage now is general liability insurance. And this is coverage when the insured becomes legally obligated to pay for damages. So within there's certain definitions that it's important to know. So a tort. So a tort is a wrongful act or omission other than a crime or breach of contract that invades a legally protected right. You can also, general liability, a breach of contract, which is failure without legal excuse to fulfill a contractual promise. When we look at general liability term, understand its occurrence. It's the accident, including continuous or repeated exposure to substantially the same general harmful condition. So when we say, okay, a fire, there's an occurrence on this date, or if we had multiple windstorms, well, it's the occurrence and when did this actually occur. And so those type of things can be important in a policy. And indemnify. The idea is to restore a party who has sustained a loss to the same financial position that the party held before the loss occurred. And essentially, when we indemnify, we're trying to make that person whole again. And those are the general terms that are important to know. You'll see most likely on the exam. So some of the commercial policies we see when we come to general liability, other commercial policies are auto insurance. I think that's self-explanatory, right? Workers' compensation and employers' liability insurance is another one. Management liability insurance. So typically you'll see directors and officers coverage for a board of directors, sometimes called, D&O or errors and omissions can be part of that. Employment practices liability, sexual harassment, those type of things. Fiduciary liability and really acting in the best interest, making sure that how decisions are made, that's where that liability coverage comes in if someone does challenge that. Aircraft, again, self-explanatory. There's ocean marine, vessel, hull collision, liability, and then cargo, loss due to sinking for pirates, even though we don't think about pirates these days, there still are pirates and, that still try to steal ships and their cargo. And then the other one is environmental insurance, right? And so when we talk about environmental, typically it's fairly expensive, has many exclusions, or it's very specific, right? So, or pollution coverage. Sometimes when we talk about environmental, it can be pollution covered. If you have underground storage tanks, things like that, that might be under that. And depending if you operate a fleet and you're a trucking firm or hauling, if you have a spill because the truck, has an accident, things like that. That's where the environmental policy insurance may come come into play. And it just depends of, what they call claims made or the occurrence. When did it occur? Was it a prior, if you bought property and it was already contaminated, many times a policy may not cover that. They'll cover basically individual instances of a pollution event or spill. So that is it for chapters 2 and 3. As for questions, go ahead and feel free to email me or use the contact on the website, and I'll be happy to answer any questions. So thanks again for everyone's attendance, and look forward to seeing you next week. We will be covering chapter 4 as part of week 3. Thanks again, and have a great night.